Welcome to the monthly housing report for September of 2022. My name is Rick Marino, principal broker at Keller Williams in Hendersonville for the Nashville metro area. And today I will walk you through three of the most important topics happening right now in the housing market: mortgage rate projections, home prices, and affordability. Now, that's something definitely on the top of mind for most people right now. And I'm going to begin with mortgage rate projections. Now, we can all agree that this year the housing market has been defined by rising mortgage rates. Here's a look at the Freddie Mac 30-year fixed rate going all the way back to January of 2022. And you can definitely see how much mortgage rates rose from the beginning of the year all the way into mid to late June-ish. And since then, you can see that there's been a lot of volatility and fluctuation in mortgage rates over the past few months. So why is that? Well, in a word, inflation. It's the enemy of long-term interest rates. And even though the Federal Reserve doesn't call mortgage rates, they certainly are making moves right now to ease inflation. And when that happens, hold your breath, mortgage rates tend to respond. So we're all watching all the different economic factors that impact mortgage rates and how that's playing out over time. And it's certainly something we're keeping our eye on. And something that we can do in the meantime is we can turn to the experts and we can say, hey, what are the projections for going forward? Ruth Hobbs of Cardinal Financial joins us. Ruth, everyone wants to know, where are mortgage rates headed?
Thanks for having me, Rick.
You're welcome.
Well, if we look at these projections from Freddie Mac, Fannie Mae, MBA, and NAR, these are the latest status we have as of August of this year. And if we average all of those projections together over the next 4 quarters, what we can see over in the right-hand column is mortgage rates are projected to essentially stabilize over the next year. That's certainly what we're looking forward to and hope that experts are correct in these projections. As we continue to watch all the economic drivers around us, and I think as we look at this, we will see some 6s, but low to mid 5s is the projection. Maybe even by next year at this time, dipping into the high 4% range.
Oh, that'd be great.
That could bring a lot of predictability for buyers. And I think the next quote really says that well. This is from Lisa Sturvant, a housing market economist that we follow, and she says, after the end of the summer lull, as mortgage rates stabilize, we may see a return of buyers and a relatively strong fall housing market. So that could be great news.
Oh, absolutely. And if mortgage rates stabilize, then we may see more buyers coming back into the market, and we'll have more with Ruth on that in just a moment. So another topic that's on everyone's mind is home price appreciation. And we surveyed about 200 Keller Williams agents over the past month, and we asked, what is the number one question that your buyers and sellers are asking you right now? And one of the top questions was, where are home prices headed? So what I'm going to do right now is break down today's home price appreciation, because this is a really complicated topic. And I'm going to do my best to explain it, because what we're hearing right now is home prices are appreciating, but we're also talking about deceleration and lower list prices. So there's a lot of confusing information out there, and I want to do my best to share this with you. So what we're going to start with is this quote from Mark Zandi, and he says, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country. So what does that mean? Well, on average, nationally, we project that home prices will continue to rise, but at the same time, we also know that there are some overheated markets throughout the country, especially out on the West Coast, where there will likely be price declines. In this chart, we can see that the depreciation is slowing, not depreciating. That's where deceleration comes into play. So let me walk you through this. This is percentage of year-over-year home price increases for 2022, and that would be to date so far. And this data is from CoreLogic. The latest data was also just released, and so what you can see here is that year-over-year, January, February, and March, home prices were still accelerating at a pretty rapid pace, and record-breaking home price appreciation at the beginning of the year. But what's happened since then? Well, we've come off that high of 20% year-over-year home price appreciation, and it's starting to cool down a bit. And that's what you can see in May, June, and July. That's the deceleration in prices. So What this means is year over year, let's say July of this year compared to July of last year, home prices were still 15.8% higher on the national average compared to last year. But that's a slower pace than the high of over 20% that we saw at the beginning of the year. So the pace of appreciation is slowing. That's called deceleration. And it's not depreciation, where we would have negative price growth. But here is where it gets kind of confusing, because in some markets, we're also seeing that homeowners are dropping their list price. So let's say you have a client whose home could have sold for $400,000 3 or 4 months ago. Well, now that home might only sell for $370,000. And in that case, it feels like depreciation, and that's because home prices are measured in a couple of different ways. So year over year, what you're seeing here is continued appreciation at a slower pace. But month over month, that's where the buyers and sellers, that's what they're looking at. That's why the feeling is there that prices are going down. And what we know is that there's still plenty of buyers out there, and there is still plenty of inventory. We know that prices are projected to continue rising, but at a slower pace. And what this means is that a year ago, the list price was the floor of the negotiation. That means you could list a home, you can maybe list a little higher than what you wanted, then buyers would still come in. Multiple offers, bidding wars, bid the price up for a home, and that was the floor of the negotiation. Now what's happening is, as the market begins to shift, is that the listing price is probably more of the ceiling of the negotiation. All right, and this is historically what we've seen over the past. Buyers have a little bit more negotiating power. We're seeing changes month over month, and that's what we're keeping our eye on right now. So home price appreciation is slowing, not depreciating on an annual basis. And I think this quote from CoreLogic really helps to articulate that. It says, annual home price growth slowed for the third consecutive month in July, but remained historically elevated at 15.8%. And that's the graph we just showed you. A 30-year fixed-rate mortgage neared 6% this summer. Some prospective buyers pulled back, helping ease overheated and unsustainable price growth. And we know the past 2 years have been an anomaly. I mean, it's been crazy. The price growth over the past year in particular was unsustainable price growth. Now, looking ahead, CoreLogic expects to see a more balanced housing market with year-over-year appreciation slowing to 3.8% by July of 2023. So by July of next year, CoreLogic is projecting that homes will still be appreciating in value, but at a much slower pace, more in line with pre-pandemic growth rates. So another factor that's in play, it's the relationship between buyer demand, which is softening, and the number of homes for sale. That is rising. So if you look at the blue bar on the left, you can see that inventory is 26.3% higher than it was the week ending September 2nd of last year. So year over year comparison for the last week of August and into September, 26.3% more inventory. So that is creating more opportunities for buyers, and it has helped with the softening of home prices for sure. But compared to the same week in 2020, inventory is still down 5.4%, and compared to 2019, prior to the pandemic, inventory is still historically low, down 42.2% from where we were at that time in 2019. So that's what's continuing to drive upward pressure on home prices. And I hope this all makes sense. Inventory is still low. We have buyers in the market. Yes, we've seen a softening, a cooling down, a slowing, but home prices are projected to continue rising primarily based on the inventory data as well. Now, Ruth Hobbs of Cardinal Financial joins us again. Ruth, anytime we're talking about mortgage rates and prices, it impacts affordability as well. So walk us through the latest on home affordability.
Okay. This is a topic that I think comes up a lot in a lot of cases. Mainly right now in the media, people are saying, are homes even affordable right now? And I want to break down affordability from a couple of different angles. Let's start with the Housing Affordability Index that NAR releases every month. It shows housing affordability right now is lower than it's been, going all the way back to the early 90s. The way that you read this, the higher the bar, the more affordable a home is. And right now you see the red bar, below the years that we show here, going all the way back to the 90s. And what stands out are the years after the housing crisis where distressed properties dominated the market. The high of that market, the Housing Affordability Index, read 197. Right now we're at 98.5. The way you read this is a 100 reading of the Housing Affordability Index is really an even reading. That means the average individual, the average household in this country can afford 100% of the average mortgage payment. So that's even, right? You make enough money to afford the average home, and that is even affordability. And we've gotten a lot of cover from interest rates over the last several years and seen great affordability. And right now, the average household can afford 98.5% of the average mortgage payment. So less affordable, but certainly not apocalyptic scenario by any means in the housing affordability. Now that's based upon three things. It's based on prices of homes, it's based on interest rates, and it's based on wages. That's how they come up with the Housing Affordability Index.
And it's a mouthful too. Well done. Now, NAR came out with this very interesting point about mortgage payments. Compared to 1 year ago, the monthly mortgage payment rose to $1,944 from $1,265. That's an increase of 53.7%. So homes are less affordable right now, and mortgage payments have been increasing. If you look at this graphically, this is what it looks like going all the way back to the last reading of June. Now, no doubt, as people have gone through the pandemic, the meaning of home has changed. And they've said, you know what? We're willing to pay for what we want. And we're seeing that right now in rising mortgage payments across the country. I'd like to wrap up with these three things that I think any buyer can do right now if they're struggling with affordability. First, you can expand your search area and criteria. Somebody that maybe was looking to buy a home near the city center or somewhere in town may need to look a little further out or look to where things might be a little more affordable than in the area that was their first choice. So that's one thing you can do. Secondly, you could explore alternative financing options. Speak to a lender and speak to Ruth and find out what you can do to qualify. Now, a lender will tell you there are products that are available in the market right now. They'll guide you through that setup and through that process. So this is how you can manage that debt based on what we've seen in rising prices and rising interest rates. And I think it's critically important to explore those alternative financing options. And the third thing you can do, you can look for grants in your area. And Ruth is an expert at this as well. You can look for grants in your area, gift funds, things like that. There are sources like downpaymentresource.com. Great organization where you can ask, what are the down payment resources? What are the resources that are available to me in Nashville or in my community? And those are arranged by a number of different ways. But a lot of times, think about a first-time home buyer down payment, a credit or grant or something like that. But look for those options. Look for gift funds to help you get into a home and combat this rising affordability. So I think there are definitely things we can do, and I'll wrap up with this. Stay nimble, stay informed, and remember, housing is traditionally one of the first sectors to slow as the economy shifts, but is also one of the first to rebound. So how do you stay informed? I'm going to offer you this. They just came out. Our fall buyer and seller guides are now available. You can download and print your buyer or seller guide right now. There's a link in the description of this video. So please subscribe to our market report and ring the bell for future notifications. And also, if you're planning to sell in the near future, ask about receiving a full retail cash offer on your home as an alternative to the traditional listing. It takes all the stress out of the selling process, and you can move when you're ready after you've found your next home. So click the link for details. There's absolutely no obligation whatsoever. Easy enough. So download your free buyer or seller guide, and that's all for this edition. A special thanks to Ruth Hobbs. My name is Rick Marino, and we'll see you back here next month.